Welcome to Unit 6, Adjustment to Final Account. We remembered from the stages of the accounting process that after the financial statement have been prepared, there could be issues or events occurring after the financial statement date, which may require adjustment to the financial statement. Among these are prepayment and accruals, bad debts, depreciation, among others. In this session, we'll begin discussions on prepayment and accruals. By the end of this unit, you should be able to distinguish between expenses accrued and expenses prepaid, distinguish between incomes accrued and incomes received in advance, make the necessary end-of-period adjustment for expenses accrued and expenses prepaid, and make the necessary end-of-period adjustment for incomes accrued and incomes received in advance. We will start with the need for end-of-period adjustment. Why do we need to make end-of-period adjustment? Parties interested in the operations of businesses need timely and periodic information. As such, the life of a business, which is in reality may span many decades, is divided into time periods of 12 continuous calendar months for accounting purposes. These periods are called accounting periods. This is the accounting period concept. Financial reports are then prepared for each accounting period. This means that in preparing financial statements, such as the trading profit or loss account for an accounting year, only items pertaining to that period should be considered. All items outside that period should not be accounted for in that period. Another important concept for our discussion is the accrual concept. Accrual means recognizing revenues as they are earned and costs as they are incurred, not when money from the revenue is received or money associated with the cost are paid. Also, revenue and cost should be recorded in the financial statement of the period to which they relate. This means that incomes are included in the preparation of final account, not when the money is received, but when the income is earned, for instance, through sales, etc. Also, expenses are included in determining the net profit, whether the expense has been paid for or not. Once the expense was incurred for the period for which accounts are being prepared, this is to enable businesses to correctly match their incomes against expenses in net profit determination and state assets and liabilities at that true values. Adjustment to final account is consistent with the matching principle and the revenue recognition principle. The matching principle states that expenses should be reported in the profit or loss account in the same accounting period as the revenue that were earned as a result of the expenses. The revenue recognition principle also states that revenue should be reported on the income statement or the profit or loss account only when it is earned and not before or after. For most businesses, revenue is earned when a service is rendered or goods delivered to the customer. It is very rare that at the end of the accounting period, all expenses incurred by a business may have been paid or all revenues earned may have been received. There are certain expenses which may be due for payment but have not been paid for. For example, electricity and telephone that may be in arrears. The business may have paid for certain expenses which benefit is yet to be enjoyed. All these call for adjusting certain items in the final account. Transactions are analyzed and recorded in the books when they take place. In the same manner, each account balance and the economic events that affect it are to determine whether an adjustment is needed. If there is a need for adjustment, an adjusting entry is recorded to bring the asset or liability up to date. The adjustment also brings the related expense or revenue account up to date. Expenses are either prepaid or accrued, and revenues also either accrued or unearned. All these need adjustments in the account. In a nutshell, periodicity issues, the matching concept, accrual concept, and revenue recognition concept, and all items not being captured in the trial balance or errors being discovered after the trial balance have been extracted. And some items that are dealt with at the end of the period, for example, inventory that is at close of the period and depreciation, are some of the reasons why there is the need for end of period adjustment. We'll start with accrued expenses. This refers to expenses which should have been paid but have not been paid. Accrued expenses are expenses which have been incurred but not yet paid for and brought into the books of account. Expenses are recorded when they are paid for in cash. At the end of the year, any expense which has been incurred but have not been paid for will not appear in the books of account. Such expenses must therefore be added to those provided in the trial balance and charged against the profit or loss account. It's treated as debit the profit or loss account with the amount accrued and credit accrued expenses account. Again, present the accrued expense as a current liability in the statement of financial position. Let's look at an illustration for accrued expenses. Rent of 15,000 cedis per year is payable at the end of each quarter for 3-month tenancy that has just expired. The tenancy commenced on 1st July 2008 and payment for 2008 were as follows: 31st March, 5th July, 4th October 2008 and 10th January 2009. Required: prepare the rent account for 2008 indicating clearly the amount to be taken to the profit or loss account. So the rent account is an expense account, and so when the rent is paid, the bank is credited and the rent account is debited. So we see that for the first quarter ending 31st March, the rent account is debited with 3,750. The rent account is debited with 3,750 because there are 4 quarters in a year, and 15,000 divided by 4 is 3,750. And the second quarter, the payment was made on 5th July 2008. So again, we credit the bank and we debit the rent account with 3,750. Then the third quarter, the payment was made on 4th October 2008. So again, we credit the bank and debit the rent account with 3,750. We realize that the payment for the last quarter was not made. It was actually made in the following year on 10th January 2009, which should have been made at the last quarter of 2008. So this amount will be carried down on the debit side of the rent account so that the total payment will amount to 15,000 and will be brought down on the credit side 3,750, indicating that 3,750 was outstanding as at the end of December 31st, 2008. And this amount which is outstanding will again be introduced in the statement of financial position as a current liability, because at the end of the year, this amount was outstanding yet to be paid. So the total amount that is to be credited to the profit or loss account is 15,000, since the amount of the tenancy payable for the year 2008 is 15,000. Prepaid expenses. A prepaid expense is an expense which is paid for in advance prior to its maturity. In other words, it's an economic benefit paid for in advance of its use. Prepaid expenses are also called prepayments. They are assets to the business and are therefore stated under current assets in the statement of financial position as prepaid expenses or prepayments. Because these expenses are paid for in advance at the end of the accounting period, they do not belong to the current year. They are therefore deducted from the particular expenses provided for in the trial balance. The entries are debit prepaid expenses account and credit profit or loss account. And again, the amount prepaid is treated as a current asset in the statement of financial position as prepaid expense. Let's now look at an illustration for prepaid expenses. Insurance premiums have been paid as follows. February 28, 2008, 1,500 Ghana cedis for a period of 6 months to 30 June 2008. July 31st, 2008, 750 cedis for 3 months to 30 September 2008. In October 31st, 2008, 1,500 for a period of 6 months to 31st March 2009. Required, prepare the insurance account and show clearly the amount to be transferred to the profit or loss account for the year ended 31st December 2008. From this question, we realize that, again, payments are made. So we credit the bank and we debit the insurance premium account. The insurance premium account here is an expense. So we credit the bank for the payment and we debit the insurance premium account. So the first payment was made on 28 October 2008, 1,500 for a period of 6 months to 30 June 2008. So the date of payment is 28 February 2008. So we debit the insurance premium account with 1,500 and credit the bank account with 1,500. July 31st, 2008, 750 for 3 months to 30th September 2008. Again, the payment is made 31st July. So we debit the insurance premium account with 750 and credit the bank account with 750. Then October 31st, 2008, 1,500 for a period of 6 months to 31st March 2008. So again, we debit the insurance premium account 1,500 and credit the bank 1,500. But realize that the 1,500 is for a period of 6 months, which is from October to March 2009. So it means that for the year 2008, half of the payment will relate to this year. Half of the payment will relate to the year 2008. So we will need to divide the 1,500 into 2 or by 2. And so we'll have 750. So 750 does not belong to this year. It's rather belonging to 2009. And we'll classify that as the prepaid expense. So in actual sense, the payment that were made for the year 2008 is 3,000 because the first payment 1,500 we added to the 750 plus the 750 that belongs to the year 2008 will have 3,000 and then 750 is prepaid or relates to the subsequent year 2009. Let's now turn our attention to accrued revenues or accrued income. Like expenses, many revenues are recorded when cash is received from the customers. Other revenues are also recorded when goods and services are sold on credit. However, some revenues may be earned but remain unrecorded at the end of the period because cash has not been received. Examples include accrued interest income and accrued rent income. Accrued revenue then can be defined as revenue earned and receivable but not yet received in the form of cash. It's treated as a current asset in the statement of financial position, accrued revenue under current assets. And the accounting entries are credit profit or loss account with the amount of the accrued revenue and debit the accrued revenue account. Let's now look at an illustration for the accrued revenues. Part of a company premises is rented to another company for 6,000 Ghana cedis per annum. For the year ended 31st December 2008, the following payments were received. 1,500 cedis 10th April 2008 for 3 months to 31st March 2008. 1,500 cedis 5th July 2008 for 3 months to 30th June 2008. 1,500 cedis 8th October 2008 for 3 months to 30th September 2008. And 1,500 cedis 7th January 2009 for 3 months to 31st December 2008. Required, prepare the rent receivable account for the year 2008. So the rent receivable account is an income, or it's a revenue account. It's an income account. So increases in that account should be credited whilst decreases are debited. So when we are receiving the rent, as because we have sublet a portion of our building and we are receiving rental income, we have to credit the rent receivable account to show the increase in the rent. So the other side of the account will be to debit the bank account and then credit the rent receivable account. So on 10th April, we received 1,500. The rent receivable account is credited, the bank account is debited. 1,000 on 5th July, we received 1,500. Again, the rent account is credited and the bank account is debited. 8th October, we received 1,500. Again, the rent account is credited, the rent receivable account is credited and the bank account is debited. But the last payment, which we were supposed to receive on 31st December 2008, for 3 months to 31st December 2008, was rather paid on 7th January 2009. So we see that this is an income which is due us, which we should have received, but we have not received as at the end of 2008. So this income is an accrued income or an accrued revenue. And so that is why we treat it as an asset under the current asset in the statement of financial position, because we are yet to receive it. So what we should have received in total for the year 2008 will amount to 6,000. So the first payment 1,500, the second payment 1,500, the third payment 1,500, and the fourth payment we expected to receive 1,500, but which was paid the following year. So the amount transferred to the profit or loss account in 2008 is 6,000. This is the rent income earned for the year, but out of this amount, 1,500 had not been received as at 31st December 2008. This amount is an accrued rent income, which is recorded as a balance carried down on the credit side and brought down on the debit side on the 1st of January 2009. After the adjustment in the account, there will be a balance on each account after the trading profit or loss account have been prepared. The balances left are either assets or liabilities depending on the nature of the balance. Accrued expenses are current liabilities, while prepaid expenses are current assets. In the same way, accrued revenues are current assets, whilst revenues received but not earned are current liabilities. Let's now turn our attention to unearned income or income received in advance. As prepaid expenses are expenses paid for before their economic benefits are enjoyed, unearned income is also income received in advance before they are earned. Example is rent income received in advance or insurance premiums received in advance. When this happens, we debit the profit or loss account and credit the income received in advance account. We treat the income received in advance as a current liability in the statement of financial position. A business rents part of its premises to another business at 2,500 for each quarter of the year payable on or before the first day of each quarter or earlier. Rent income received during 2008 are as follows: 1st January, 31st March, 29th June, 1st October, and 30th December. 1st January for 3 months to 31st March, 2,500 Ghana cedis. 31st March for 3 months to 30th June, 2,500 Ghana cedis. 29th June for 3 months to 30th September, 2,500 Ghana cedis. 29th December for 3 months to 31st March, 2009, 2,500 Ghana cedis. Required, prepare the rent receivable account showing clearly the amount to be transferred to the profit or loss account. And so this is how the rent receivable account will look like. It is clear from the account that the tenant has paid the first quarter's rent of 2009 few days early. Since the amount for the first quarter of 2009 is received in 2008, it is an unearned rent income. The transfer to profit or loss account for the year ended 31st December 2008 will be 10,000 Ghana cedis, and the additional 2,500 will be earned in 2009. On the statement of financial position, the amount of rent received in advance will appear under current liabilities as rent received in advance or unearned rent income. In this session, we distinguish between expenses accrued and expenses prepaid, between income accrued and incomes received in advance, and made the necessary end of period adjustment for expenses accrued and expenses prepaid, and incomes accrued and incomes received in advance. Thank you.